All right, everybody. Happy Tuesday. Thank you for checking in here. Going to talk about Bitcoin. Haven't talked about it in a bit. Also going to look at the growth of money. Just a little update on physical cash. Haven't done that this quarter. So I'm going to show a couple charts here. Got some good ones today. Let me change my camera for you here. All right. So I want to talk about population growth. There's obviously a lot of things we could say about population growth, but broadly speaking, the gold bugs like to say that population generally grows at 1 to 2 or 2 to 3% per year, depending on where you are in the world. The world average is more like 1 to 2 at the moment. And since gold comes out of the ground at that same rate, it's an asset that more or less makes sense as money. And there is some truth to that. There is definitely some truth to that. But as we know, gold has some physical limitations that Bitcoin does not have. Okay, so gold can be confiscatable in the same way that Russia's foreign currency reserves were confiscated during their criminal invasion of Ukraine 3 years ago, ongoing. So I just want to run through that and put some numbers on population growth and also layer in money growth to see how that might affect the purchasing power of your dollar, euro, yen. All right, so here's world population. This is from the IMF. I used to have World Bank going farther back, but just for now, let's go from 1980. IMF figures. This little bump here is more or less the end of communism. My understanding, let me know if you know anything more, but my understanding, it's a little bit more clear on what the Chinese and Soviet numbers were than before. And that's why you had that little bit of a bump here. But here's world population, basically a steady, consistent growth. IMF always has their numbers a little bit under World Bank, UN. So this, it is, most people think it's 8 billion, but this is just the number that I have for sort of consistency as a denominator. So we're going to leave it here. A little bit less than 8 billion, although we probably have a little bit more than 8 billion people at the moment in the world. All right. Now let's look at, before we look at cash and the growth of cash, let's look at different economies. Okay, so emerging versus developed. This comes from the IMF as well. Perhaps you've heard the term golden billion. So of the 8 billion people in the world, really only about 1 billion have, developed access to major infrastructure. Maslow's hierarchy of needs is more or less taken care of. That's right here. All right. So golden billion. Developed economies. China and India are not included, even though you have many areas of China and India that are developed. Overall, they're not included in this number. Okay, so 1.1 billion people and 800 million people back 45 years ago. All right, now let's just put emerging on. It's obviously the difference. Okay, so 7 billion people in emerging economies. That, of course, includes China and India, over 1 billion each. So roughly speaking, 8 billion people, golden billion, and then 7 billion in emerging economies. All right. Let's look at the growth of population. This is blended. Okay, so it's going to be both emerging and developed. But let's look at population growth. Okay, you have this spike here going up to 5% in the fall of Soviet Union and China opening up a little bit, but more or less 1.8%, and then it's actually falling. So this was, a lot of people were saying gold was great for money during this period, which population growth was around the growth of gold coming out of the ground, about 1.8%, 1.7% per year. It's fallen though. Okay, let's take out the emerging and developing and just World population growth has been falling. The rate of increase is less. Let me be precise there. The population growth, the rate of growth is falling. Population is still growing, but the rate of growth in the world is falling to where the estimate right now by the IMF is 0.5% per year. So that's interesting in and of itself. A lot of different conclusions we can come from that. But let's put on the growth of money and see how that might change the picture. So first, I'm just going to put on the stock of money. It's going to be on the same left-hand axis, all right? And this is unlike the monetary-based stuff that I do, which includes the bank reserves, which is like bank money, still part of central bank money, but it's more of a ledger. It's more digital money. It's just basically by the stroke on a keyboard, a central bank can add it to their banking system. This is only that physical printing press, all right? Physical printing press in dollar terms. I'm going to put it on left-hand axis now. Okay, let's take off the growth rate for a second, just so we can see. Just so you can clearly see it, it's right there. This is full-on cash. $9.4 trillion equivalent in dollars, euros, yen, yuan, sterling, Swissy, francs, Brazilian real, Argentine pesos. $9.4 trillion all across the world in cash money. Back in 1980, it was 400 billion, roughly. 400 billion to 9.2 trillion. All right, so let's actually look at the growth of money before we put the growth of people back in. Let's look at the money growth. This is straight up annual growth, rolling annual growth, nothing fancy. All right. Can be erratic, can be as low as, say, even a slight decline. But again, there's different ways to measure this. It actually didn't decline in native terms, but in dollar terms, which I'm measuring just the growth rate in dollar terms, it did decline. That's actually a loss in the purchasing power of the dollar for most currencies. Because remember, the dollar is only actual dollars, is something like 2.2 some trillion. So the world, 9.4, the actual Federal Reserve notes, many of which are around the world, are only 2.3, closer to now, trillion dollars. So we measure this just straight up dollar sort of purchasing power of physical cash. Okay, and you have to use all different currency rates to get to this chart. But then you just measure the rate of dollars. You see this big bump. What's that? It's Y2K. Okay, so literally people were freaking out. Libertarians were burying tractors. People were very worried about a world-changing event here in Y2K. And then it receded. The world didn't end. But it's still erratic, right? It can be as high as 24% here in January 2003 as Baby Bush got ready to launch his Iraq war. Then down to 0.8%. This is an annual growth, annualized. So December 2005 over December 2004, 0.8% per year. And around we go. And when this goes negative, again, this is more of a loss in purchasing power than a central bank's not printing, but that's hard to do because we have Wittgenstein's ruler here. I have 50 different currencies behind this dollar figure. Nonetheless, you're going to get an idea of just how money grows, okay? Big COVID pump here, 16% per year, more or less in cash, physical cash. All right. Remember they were saying how don't use cash? No one's going to use cash, only use digital. Well, they printed physical cash. Dirty physical cash was printed up during COVID. All right. So 9.4 trillion. It's erratic. The growth rate is clearly erratic and can be up to 20%. It can be down to 1% growth rate per year. let's just say it's 1% per month. Let's say it's 13% compounded, which it would, that's what, it's not 12% per year if it's 1% compounded. Let's say 13% per year, something like that. Okay. In the growth of physical cash. Now let's put people back on. All right. And let's put the population growth rate. Okay. Notice how this smooths out because it's so much smaller. And we can start to draw some conclusions about how, if we want to have a few basic assumptions about supply and demand, we can have a conclusion about the purchasing power of money. All right? If you get to this. So economics is as I say, the dismal science, but we can figure this stuff out. Okay, so my headline number that I usually talk about, and this includes the monetary base, okay? So the actual physical cash growth is a little bit less, but I'm still going to use this number. It's 13% per year, roughly, okay? Physical cash grows at 13% per year, compounded, like a smooth number of all this jumbly stuff. Whereas population, at the moment, only grows at 0.5% per year. 0.5% per year. All right. If we wanted to understand then the change in value or the change in price or the change in purchasing power of money, we can just with a few assumptions. So if I would assume that this is world population is demand, and the growth of money is supply, indeed it is. The supply of currency is right here. Then the relative inflation rate, all right, that is the relative rate of inflation to demand, is simply supply minus demand. But we have to say that this is a very basic economic scenario. Oops. I'm just on Investopedia here. I'm assuming this middle scenario. Okay, these are 5 basic scenarios of supply and demand. It's called the price elasticity of demand. All right, I'm assuming unit for unit or unitary elasticity. Okay, that means the price will change based on an equivalent percentage change in demand. Okay, and this is where economics and modeling can just get so messy and annoying and stupid, and no one does it in the real world anyway. But if you want to just get to the basic fundamental assumption, it will work out. It will work out to say. Let me take off the money growth because it's just too much in this chart. But look at the population growth. It's 0.5%. And let's even say 1%, okay? Because 1% is something we can say like closer to an average, okay, over the last 45 years. Let's say population growth is 1%. That's the growth. That's the relative change in demand of the world. And the money in that world grows at 13% per year, compounded. So what's going to be the relative change in price? All right, it's very simply supply minus demand. Okay, so I have a supply that's growing at 13% per year. Demand only grows at 1% per year, just very, very basic round numbers. That will mean that the elasticity of price meaning the value of money, will inflate or decrease at 13% minus 1%, 12% per year. 12% per year. So this is why I believe, and I've always believed, look at what they do, not what they say. They talk about inflation rates being, 1 to 2% per year. Look at how much the money supply actually inflates. The money supply inflates at 13% per year. compounded. And I would grant you, as an economist, I'm not a certified economist or anything, I'm more of an economic observer. I would grant you that that's not the full, definite reflection of a change in price, but it is the change in the stock of the money. And so if you want to back out, let me say it this way. If demand for money would increase at 13% per year, then there would be no change in prices. Ceteris paribus, the old economic phrase. If the supply of money grew at 5%, 10%, 15% per year, but demand also grew at that same percentage change, then there would be no change in prices. But that's not what happens. And we can empirically demonstrate that worldwide by looking at the growth of population versus the growth of the total global money supply. All right. And what happens is supply grows by 13% roughly. Demand grows by 1%. So assuming unitary price economics, unitary price elasticity of demand, you just simply subtract those numbers and then you'll get the change in price or the change in the loss of the purchasing power of that thing because this is money. So you can say it's something like 13% per year compounded is the growth of this, minus the change in demand, which is the growth of population, 1% per year compounded. Over 45 years, you're still getting something like 12% assumed change in price. When I say change in price of something like money, that means the price of that money is going down. Sorry, the value of the money. Economics, right? The value of the money is going down, the price is going up. So that is how it works. Then the question becomes, if we know that the purchasing power falls by something like 1% a month, 12% a year, something like that, what is an asset that can protect us from such a loss of purchasing power of 1% per month? Without going too much into all of the charts that I typically show, I'm just going to tell you. Gold has given us, since 1970, something like 7% per year compounded. It's maybe a little bit higher with the latest bump, but over the long term of fiat money, something like 7 to 8% per year. Stocks, S&P 500 is given 7%. If you reinvest those dividends, you get 9%. And bonds, a little bit more tricky to calculate because this is, S&P 500 is a pretty good benchmark because it's 80% of the U.S., hegemonic stock market value. But bonds are a little bit more tricky. There's a lot of different bonds around the world. Some bonds are safer, more safe than others, but let's just roughly say it's less than stocks. Okay, it's safer and therefore less of a return. So 4, 5, 6% per year. Let's just say 5. The 10-year Treasury right now, by the way, is yielding. It's higher than it certainly has been. It got up to 4.5 during Liberation Week. Now the yield's down, prices up to 4.35%. But that's what you're getting with a theoretically safer asset than stocks. But notice all of the numbers that I have just told you. Have they caught up with this decrease in the purchasing power of money? Because I've just showed you empirically that demand only grows by 1% per year worldwide. Cash grows by 13%. That means the decrease in the purchasing power, the value of money, is about 12% per year, 1% per month. Did any of those investments on a trend line benchmark beat it? The answer is no. Over the long scale, 50 years, gold didn't beat it. The S&P 500 didn't beat it. Even reinvesting dividends and bonds didn't beat it. So if you're an investor and you're just thinking about the law of averages and sort of broad returns, it's actually quite challenging to beat the growth of the money supply worldwide. Unless, of course, we are lucky enough to fall into the great, wonderful asset of Bitcoin. You knew I was setting that up. Okay. So let's take off the noise. Just a little update here, but let's take off the noise of all this stuff. Talked about this a lot recently. Again, Bitcoin is the stoic asset. So we can draw a trend line on the movement of price of Bitcoin over the last 15 years. And true, it's not as long of data as this, which is 40 years. Okay. Stocks, which the numbers I just quoted to you are 50-year numbers. Gold, it's another 50-year number I just quoted to you, about 7-8% per year compounded. This number is over 200% at the beginning. All right, and it's fallen. As you can see, the rate of growth of this curve is slower. This is log scale, okay? But again, just to remind you where we are right now on the slope of the curve, not the slope of any price change at any given time, or when Peter Zeihan was trying to tell Joe Rogan that Bitcoin was $17,000 overvalued here. I love that episode. The slope of this curve, a broader, more stoic view of Bitcoin. Right now, we're moving somewhere from 45% per year compounded as of the end of last year to 42% per year compounded at the end of this year. And as I've said many times, you got to wait 100 years. 100 years for the slope of this curve to reach a growth rate of 10% per year. So, the lesson, in my opinion, the world is growing. Yes, it's growing a little bit slower than it was before. I don't know enough about the demographics to say we're in a what Elon Musk says is a population collapse. I don't know. The golden billion is growing, although at a very stable, certainly a stable level. Emerging economies are clearly picking up the slack and growing faster. But brass tacks, if money is growing at something like 13% per year, population growth 1, even call it 2, that's 11 to 12% hurdle you got to reach to beat the inflation of the money supply. You don't even have to look at prices. You can just intuit economically. That would make sense, would it not? This is demand. This is supply. And assuming the theory of the unitary price elasticity of demand, okay, you can do a simple subtraction between those growth rates to get the price change. In the value of money. All right, so that was the little economic soapbox. We got Bitcoin. Once again, just to show you, my APIs are still not, I'm in a reset mode of my APIs, so this chart is still, unfortunately, 2 days old. Okay, but we're about that price range right now, actually a little bit higher, 85,000 as of recording, okay? But you're still going to get the idea here. So a 30th percentile drop, all right, is way low. You have to go to 0.5x the trend. We were back here when, Peter Zeihan was pontificating about Bitcoin. I don't see that at all. Here's a 40th percentile. That's a 0.6x the trend. The trend is the black line. I don't see that happening either. We passed that in November of 2023. I think we're off to the races there. Let's look at a 50th percentile. These are very hard to see, I know, on this. Going from yellow to red or cool to hot. Blues down here, blues and purples down here. Anyway, this is closer to sort of a trend line that we test mathematically. Okay, we tested it and we pierced it in September. And we got close in April, but we're still above it. And then the 60th percentile in orange. This is a much tighter band. You can see it's moving up and down more. Okay. We're under that. And what this says is based on how this green line or area, the price, moves around the trend, 60% of the time, it's going to be under the trend, okay? And indeed, the price is. The trend line itself, the price itself is under the trend line, okay? So we're a little bit under 60th percentile, somewhere between 50th and 60th. But you can clearly see that if we think about the trend line as the mean, that's how you should think of the trend, as the mean. It's not exactly the mean, but you think of it that way. We're very close to the mean. Yes, we're above the mean. We're even above the 70th percentile for a couple months around Trump inauguration. Have not hit 80th percentile yet. 90th further away, and then the 100th, which is like every single observation based on multiples. We're not even close. I do see this getting, like I said many times, getting close to the 90th on the next top. I think 100th, is sort of moon territory, but over 90th, I do see it. Never financial advice, but here we had it in March, April 2021. We also had it in November. All right, the 90th was, we just had it briefly, very briefly in November. So if we assume the 4-year cycle, we pull out, just so you know again, a 90th percentile move again is 2x the trend. So the trend is 125K by the end of this year. 2x is 250K. I think that's conservative and certainly possible. All right. Here is another way to look at, another way to look at where we are in the cycle is the price to sales ratio. Remember, this is kind of a unique one. It's total mining rewards and fees. How many times does that go into the market cap? Okay, on a rolling trailing 12-month basis. So at the moment, April 13th, at a $1.65 trillion market cap and only 13.5 billion in trailing 12-month miner revenue. This is a price to sales type of a metric. All right. So that means that the revenue for miners, the revenue for the Bitcoin network, is 122 times smaller than the market cap, 123 roughly. Close to record highs. Okay. Not actually close to, not actually all-time highs, I should say. Okay, because remember, we hit 170x here in 2021. 2017, we hit 113 or so. And right now we're at 123. But this is not this is an interesting multiple, all right? So this multiple seems to grow. Unlike, PE ratios or even price to sales ratios for tech companies, those are pretty small. If you look at the price to sales ratio of Apple right now or something, you'll find something that's like 4. This is for Bitcoin, for blockchain networks, this thing that I haven't gotten on my website yet, but I've been tracking this since the start of my website in 2017. This thing has been growing, interestingly. So you see where we are relative to the bounds. We're not at the top. And then here with this one, I can show you, so with the 2%, the second percentile on the lower side, the 98th percentile on the upper side. I do think, again, we're going to get pretty close to the 98th percentile based on history. We hit this in 2011, 2013, 2017, and just kissed it in 2021. Actually, we were lower than it, but just kissed it. The 90th percentile was 172x, the trend of this multiple. And we hit 171. You don't really, you can infer price here, but I'm not doing this. I'm just showing you this multiple to show how hot we are right now. And we are, in this one, it's interesting. We're above trend, okay? Because remember, in this one, in this one, we're below. This is really the hardcore model, right? This shows you where we are relative to price. We're below trend. Here, we're above. This orange, our actual PSR is above the trend line PSR. But I have, based on the way this stuff works and market dynamics, I really see, I see during the boom that this will get pretty close to the red line on the top. It's just has done that always in prior booms, and I would assume it would get close in this boom. It might not touch it. It might not be a perfect exit or drawdown signal. All right, if you want to move back into fiat after holding some Bitcoin. But I think it's pretty good. I think it's a pretty good indicator. And so bottom line is we're quite a bit from the top still. On an uptrend, quite a ways from the top. Last one I wanted to show you, back to this value. Okay, so let's take everything off but cash. And let's put money growth on. Annual money growth. So as jagged as it is, as unpredictable as it is, it does grow. That's the predictable thing, but we don't know exactly how physical cash will grow in the world. When could Bitcoin hit $9 trillion in value? We know it hit $2 trillion, over the end of last year and the start of this year. When could it get to 9.4 trillion, which is the value of cash today? It's obviously not going to do that tomorrow. I'm not a subscriber to the hyper Bitcoinization thesis, simply because there's a lot of people here that use cash. Yes, I know digital transacting in the emerging world on phones is huge, but there's still a huge demand for cash in the emerging world. Even if you want to say that there's no demand in the golden billion for cash, look at the green shaded area, it's growing. Look at what they do, not what they say. All right, so let's ask when could Bitcoin possibly get to $9 trillion in market cap? So here's the market cap right now, 1.6. Zoom in. We were in started this year, end of last year, hit that 2 trillion mark for the first time, right? Yeah, first time. Okay, incredible feat. We'd hit $1 trillion a few times before, but getting up to 2 trillion already, unbelievable growth of Bitcoin in 16 years. So let's do the power trend on the market cap. It's actually a stronger R squared than the price. So under the trend line, just like with price, got that nice, beautiful power curve. And let's extend it out and see how long, how quickly can Bitcoin get to the growth of physical cash value today, which is $9 trillion. Again, if you think Bitcoin's boring, or you'd rather shitcoin yourself into trading oblivion, look at how fast this grows. The growth of the trend line. Okay, not the, we can't predict anything more than a trend. All right, that's all we can do. So once the actual values stop, around 1.6 trillion, let's go out. 2027 is here. We're already over 4 trillion. Mid 2027, we're over 5 trillion, 6 trillion early 2028, 7 trillion late 2028, 8 trillion end of 2028, and we don't even have to wait till the end of the decade for that roughly 9 trillion. Let's go to 9.5 trillion. Mid 2029. Early to mid 2029. This is the best that I can give you about being a stoic, not worrying about tariffs or the market, using the escape hatch that Bitcoin affords one, and when I say affords, I mean offers to, your family, friends. Use multi-sig. It's less than 5 years away. Less than 5 years away, as projected by the power curve, which is simply a representation, in my opinion, of the adoption of Bitcoin. Less than 5 years before we reach the dollar value of physical cash today. Of course, physical cash today will continue to grow. People think that it won't grow. I think that it will. So there's going to be a convergence, and I don't have that chart up to show the projection of physical cash, a trend line on physical cash. But it's important to know that physical cash is growing exponentially at a slower rate. Bitcoin is growing in power at a faster rate. So it's going to be probably longer than 5 years to actually catch the worldwide value of physical cash, which is around $9 trillion. But let's say it's 15 trillion even. Look at that. The trend line projects before, depending on how you view the end of the decade, because some people would view it as not just the end of the 2020s, but into 2030. Regardless, 2030. End of the decade, start of the new one. Remember, time zero. There's time zero in the first year. End of this decade, start of the next, we'll get to 15 trillion. And it's probably something like that will be the growth of cash. I'll do the math right now. If it's 9, let's say, it's 9.3. I can't share my calculator, but what I'm doing on a calculator is just taking 9.3 times 1.12. Let's just assume 12% per year. Okay, that would give us 10.46 times 1.12, 11.66. That's 2 years out. Times 1.12 again, 13 trillion. That's 3 years out, times 1.12 again, 14.6 trillion. So 4 years out, we'll be at 14.6 trillion. Yeah, it's basically, as I said, somewhere probably at the end of the decade, the growth of this cash should match the growth of this, somewhere around 15 trillion, 14, 15 trillion. So there's plenty of time to get on the Bitcoin bandwagon. I just can't express enough how strong and awesome of a trend this is, how beautiful of a trend it is. Let me try to explain again, I've done this many times, why Bitcoin is not exponential. Okay, so if you took, let's put log left. And let's take this off. You can draw straight lines through each of these numbers, okay? And obviously the slope of the blue, world population growth, is very slow, 1 to 2% a year. It's very flat. And the slope of money is very fast. Lose your purchasing power faster than demand can sop it up. It's very steep. You could draw straight lines through both of those curves. They're exponential curves, right? we can also try to shoehorn an exponential curve into Bitcoin. I've done that for you. So let's shoehorn an exponential trend into Bitcoin right there. Does that look like an exponential trend is following the Bitcoin market cap growth? We're way above it here. We're way under here. And then you got to go all the way back to 2022, the last time the market cap was even close to the exponential trend line. And if we were on exponential, we should be at $11 trillion market cap today. But we're not. It's not a problem. Power growth is how networks grow. Exponential growth is how other things grow. Typically not networks. So Bitcoin is just, it's different. Gold, worldwide population, S&P 500, stocks, bonds, they all grow exponentially. They're all straight lines on log scale. Bitcoin clearly is not a straight line growth on log scale. There's no way. We're way off it. Even though we're in an uptrend right now, and we have been since 2022, much better fitting trend is the power trend. And let's just try to drill home this point now. Let's go back out to the end of the decade. All right. Let me take this off just to give us the thrill there. Again, remember, 15 trillion we can even hit we can hit it in 2030, right? $15 trillion market cap for Bitcoin. Let's put on the exponential trend, see what it says by late 2030. Do you understand this number? I gotta go, somewhere October. 15 trillion on the power curve. Do you understand what it says when it's saying 1,481,000 billion? Do you understand what that number is? It's a quadrillion dollar equivalent. So if Bitcoin was actually on an exponential trend, then by the end of the decade, when we should be meeting the exponential growth of the physical money supply, if Bitcoin was itself on an exponential trend, it would be at a $1.5 quadrillion market cap. A quadrillion is 1,000 trillion. I showed you yesterday a chart of the U.S. financial assets that foreigners own. Okay, it's something like $34 trillion. Right, that's what foreigners own of government bonds, corporate bonds, and stocks. The total domestic value of that, according to the Federal Reserve, is something like 140 trillion. All the government bonds in America, U.S. Treasuries and agency bonds, all the corporate bonds in America, and all the stocks in America. Remember, the stock market itself is only $50 trillion, and we know that that's down 10 trillion since Trump was inaugurated and voted in. $140 trillion. This is saying, this projection here, an exponential curve of Bitcoin, is saying that Bitcoin itself in just 5 years will be 10 times the amount of all stocks, bonds, and government bonds in America. It's not going to happen. It's the wrong time scale. It's the wrong mathematical scale. Bitcoin does not grow exponential. All right. I think that might have been it. I showed this one. I tweeted this one yesterday. Here we go again. Government bonds, corporate equities. Okay. This is just the percentage owned by foreigners. Foreigners. So these are all financial securities, financial assets that are liquid in the United States. This doesn't include things like real estate, but real estate could be behind this securitized. Remember, real estate, gold, all that stuff, that's assets, machinery, property, plant, equipment. This is the liability and equity side of the balance sheet. As I said, total U.S. domestic securities, something like 140 some trillion. Foreigners own 34 trillion of that 140. The largest shareholder of that is non-U.S. NATO members, 14 trillion. This chart actually shows you a lot, and it could maybe question what's the plan for the Trump admin, certainly with tariffs. Because you see over the last 10 years, BRICS have not even grown at all their investment into American securities. Japan has grown, but not too much. We know they have their own problems. So it's really Europe. Canada's in here, of course. This is America's biggest ally, actually has the biggest share of financial interest in the United States, which is interesting. We're going to see how this goes. What would this fourth bar, what do you think this fourth bar is going to look like in January 2030? Do you think BRICS, like Trump opening up investment to Russian investors, oligarchs, do you think that's going to shoot up and America's going to be better off? Is this going to come down? Maybe Americans will own a greater portion of a bigger stock and bond market. Maybe. But I think this chart really right here paints an interesting picture about the way the current administration is treating its allies with a stick and its enemies with a carrot. So we'll see. Let me know if you guys have any comments about this. We have the Treasury yield recovering a little bit from the slide after all the chaos of the tariff whiplash last week. Recovering. Yield is down. That means price is up. And as well, the S&P drifting up again. As I said before, I'm not a trader, long-term trader. I'm not a huge believer in that, and more power to you if you can do that and trade and make money and have screens open all day. But I do think this is a very interesting chart, just because we know the intent is at least there to change the global trade system and perhaps the global investment system and perhaps the dollar system even. We're still not out of the woods by any stretch of the imagination. Is the electronics and computer exemption period paused, or are those not exemptions? We've been hearing every different thing from the admin. I'm not seeing too many comments today, so we may close it down. But if any of you guys want to review the trend lines again, we can. My main message is just we're lucky. We're lucky that we have Bitcoin. I think that we're lucky. This line, remember, this is the silly line. The exponential line is silly. But this power line is just comfort amid chaos. You got a declining monetary base, a declining money supply here. Here, the global monetary system was printing, right? I should say you have a declining U.S. monetary base here. But at this stage in the game, I still believe it's not actually about printing. Even though I've been posting these monetary base updates since 2018, 7 years now, the main driver here is adoption. What you're seeing here with this curve is, and this price curve, is an adoption of Bitcoin. Because unlike this chart, where supply is not capped here at our $9.4 trillion current amount. There's no cap on this. It's purely at the whims of central banks. We know that the supply dynamics of Bitcoin constrain it and effectively reduce the supply by 16% a year, i.e. they have every 4 years. So it's interesting dynamics. I think that if we didn't have Bitcoin and we saw this just keep going, it would be gold. Gold would have been the next safest bet. But as we know, they can confiscate gold. They've done it before. And even though it is true that nations are anarchic, means anarchy, on the nation state level. And you see Germany now saying they want even more of their gold back, which is still in the United States. And they've done this, by the way, over the last 20 years. The United States has been in a privileged position over the last 80 years because 80% of the world's gold, which really means European gold, but there's also some Asian gold as well. But 80% of the world's central bank gold went into the United States already during the first year of the Second World War. So it's basically been downhill from there as far as the United States being the apex predator, the supremacy of both having all the world's gold and having the reserve currency that the world wanted to hold. Till now, even perhaps weirdly, intentionally damaging their dollar position by trying to force trading partners to perhaps not want to deal with them. The question is going to be for the dollar. The dollar is and the 10-year in particular, this is just the no bullshit signal. No matter what Trump might say about the supremacy of the dollar, if there are other assets out there that other people want that can protect in a risk-off situation, then maybe we will see, like we saw here, yields rising while the stock market was going down. Yields were rising. Really wild scenario. That's just, as far as I know, has really never happened since 1970. But we'll see. We'll see what Besson can do here. Any questions? Let me know. Otherwise, I think I will end it for today, guys. Have a good Tuesday. Oh, tax day in America. I didn't even think about that. Happy tax day. I guess based on the average tax rate, you still haven't worked off your wages through the year. I think that's well into the summer. Come back with that for tomorrow. Supply versus demand. That's what it's all about. And if we assume unitary inflation, or unitary elasticity of price, then you just subtract the growth in supply minus the growth in demand, and that will get your real inflation rate. All right. Thanks for watching.